Coming up on Market to Market. As the president's budget arrives on Capitol Hill, what's in it for rural America? And the start of a new chapter for Market to Market. Those stories and market analysis with Mark Gold next.
Great growing season.
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. This is the Friday, February 16 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Paul Yeager. Many rural Americans have been hoping for an early spring, but about the only thing heating up consistently have been food and gas prices. The hotter rates have put a chill on purchases. Retail sales fell in January by 0.5%. Stripping out the volatility caused by food and energy prices, retail sales were even with December. The cause for those drops could be seen in the Consumer Price Index, which moved 0.5% higher last month. Core CPI, which strikes food and fuel from the equation, climbed 0.3%. Creighton University's Rural Main Street Index rose above growth neutral for the first time since May of 2014. The move surprised economist Ernie Goss, the survey's author, in light of lower commodity prices, limited economic growth, and fewer bank loans. President Trump is calling his budget plan efficient, effective, and accountable. Contained in the 154-page proposal were a few paragraphs on investment in rural America. The debate has already begun on how the bills will get paid. Peter Tubbs reports.
The White House printed its proposal for the 2019 budget this week, and rural America was included in the request. One highlight of the budget proposal is for $200 billion to be spent on infrastructure projects across the country. $50 billion of that spending is targeted at rural America. According to the Congressional Budget Office, the federal government spends an average of $100 billion per year on infrastructure. The money is combined with state, county, and local government spending of an additional $300 billion per year. The budget proposal calls for $100 billion to be spent on incentive grants for projects that create revenue streams, prioritize maintenance, and streamline purchasing of materials. The White House believes the grant process will generate another $800 billion in funding from local governments and private companies. The budget also asks for streamlining of the permitting process and moving the bulk of the decision-making down to state and local governments. The American Farm Bureau cheered the infrastructure plan. We applaud the administration for placing the decisions of how these dollars should be spent back at the local level. Governors and local officials know their roads and bridges better than anyone, and they are ready to set their priorities for rebuilding rural America. The National Corn Growers Association had a more cautious reaction to the plan. While NCGA is pleased in the investment in rural infrastructure, plans outlined to address water transportation systems cause some concern in their current state. The National Farmers Union was divided in its opinion. The advocacy group was pleased with the dollars requested for rural America. We are encouraged that the administration is acknowledging the need for significant investment in rural infrastructure, and blasted cuts to the USDA, SNAP food assistance, and the Farm Bill as a whole. This policy fails to step up for family farmers and ranchers who are expected to endure yet another year of declining farm income. As much as the Trump administration has made its spending requests, Congress has often gone its own way in the past. Last year, Congress largely ignored the White House requests in the 2018 budget. For Market to Market, I'm Peter Tubbs.
Next, the Market to Market report.
Rain in the wrong places, a cheaper dollar, and fund buying helped stir up the commodity markets. For the week, March wheat gained 9 cents while the nearby corn contract moved 6 cents higher. Argentine producers holding on to their harvest, and South American rain that failed to materialize pushed the nearby soybean contract up 39 cents. March meal continued to lead the soy complex, jumping $29.50 per ton. March cotton shrank 47 cents per hundredweight. Over in the dairy parlor, March Class 3 milk futures gained 50 cents. The livestock sector had a few bright spots as the April live cattle contract added 402. Nearby feeders advanced 353. However, the April lean hog contract seesawed its way to a 70-cent loss. The U.S. dollar index plunged 132 points. Despite a rising rig count, April crude oil moved back above $60 as it gained $2.56 per barrel. COMEX gold poured on $40.50 per ounce, and the Goldman Sachs commodity index gained almost 15 points to close at $443.45. Here now to lend us his insight on these and other trends is one of our regular market analysts, Mark Gold. And in case you want to go over things again, you can download or listen to our Market Analysis and Market Plus podcasts online anytime at iptv.org/MTOM. Mark Gold, welcome back.
Nice to be back, Paul.
What do we start with other than the weather, especially when it comes to the wheat market? Continued dryness in the plains, maybe some emerging crop. That market going up almost 2% on the old crop. What is continuing? Is there anything else driving this market than weather?
Well, certainly the weather is the prime factor, but the U.S. dollar made new lows on Friday, came back, closed higher, but we haven't been this low in quite some time on the dollar. We had it down to 88.25, I think, during the day here today. That certainly should help the wheat market a little bit, but it's really weather. When you look at the weather, Texas, Oklahoma, Kansas, we've got some serious drought conditions out there. And we all like to say wheat is a weed and it's going to grow through anything. But we better get some really good April and May rains to bring this crop back, or we're in some serious trouble, and on lower acres.
There was a story this week about near Dodge City, Kansas, so that southwest part of the state. They haven't had a measurable rain in almost 5 months.
Yeah.
And that's a consistent story around that area. So if you don't get rain and you're a producer in one of those spots, what are you doing on that new crop?
Well, the only thing you can do when you're not sure of production is to protect the prices with a put option. We've had a great rally in this market. You've got an opportunity to spend 20, 25 cents to protect it. If you do grow the crop and we find out in 3 or 4 months there is a crop out there, these prices can get back $1 pretty quickly. If you don't have the crop, yes, you're going to lose some money on the put because you don't have the crop unless the market goes down on its own for whatever reason. But the fact of the matter is you'll get a huge insurance payment. In order to become a better marketer, you have to have crop insurance and a marketing plan. So yes, you might lose a little bit on the put, but you should have a big insurance check coming.
What do you do if you are in that position of it's dry? There might be a position of continued dry. Do I pull the trigger and make a sale right now on what I have sitting in the bins?
Well, I think you have to look at your own crop. It's really pretty individual. You guys will know whether or not there's any chance of some of the stuff coming back. I've seen some seedlings that there was no question they were dead. But on your own farm, if you think that there's a chance, then I think you go ahead and sell 10, 20% of your guaranteed bushels at these levels just to get something sold. You should have something out there to deliver, but I wouldn't get too far ahead of it and keep that put on in case there is a good surprise out there. As we've seen over the years, we can look dead this time of year and wind up with bumper crops. So I think you still need to protect that risk.
Now we're about to see a contract expire. December already over $5. Can that nearby one tick up any higher?
Yeah, I believe it can. The funds are still heavily short. As of Wednesday night, they were short about 73,000 contracts of wheat. They haven't gotten out. The technicals certainly indicate they should be out. Not only should they be out, they should be long in here. So, I don't know what they're waiting for, but I would think they're losing some serious money in here.
All right, well, let's talk about maybe gaining some money, and that's about storage. We have a question that came in via Facebook. Ben in Cazenovia, Wisconsin. He wants to know, Mark, with zero on-farm storage, should one buy December corn call now and sell for fall delivery, or roll the dice on weather to price?
Well, we had a nice rally in the corn. New crop is up to close to $4 a bushel. There's nothing wrong with making a few sales up here. We just started in the last week making a few light sales up here, 10% of the crop basically. So there's nothing wrong with that. Your call really at that level is the crop that you tend to raise. So I don't know that I'd be buying calls so much on the corn in here. The beans are a different matter. If you've got beans sold, we've been recommending all along to re-own it with call options. Most of our clients that have bought the calls are looking at some pretty good gains in those positions. And it's the wrong time of the month for this market to quit going up. The funds are now long the beans. They're heavily long the meal. They're still short a little bit of oil. But this market looks like it's got some legs to it, and it's really going to be dependent on the Argentinian weather. This weekend, they're looking at maybe a few scattered showers north. They've been looking for those, get a few here and there, very spotty. Market continues to move higher. So if we don't get good general rains, in particular in the south in Argentina, I think it's going to be higher prices. If we get the rains, then this market's going to roll over, and we're going to be right back to where we were under $10 in a heartbeat.
Because we're at levels we haven't seen since about late October right now. So if you would have sold off the combine, there was limited cheering about this because this is what you thought you should have. You're not supposed to sell off the combine.
Well, there's nothing wrong with selling off the combine if you replace it with call options, which is what we recommended. If guys didn't have room for it and they wanted to sell it, raise some dough, that's fine. But we've been pleading with guys for the last 6 months. If you're selling any crops at these kind of historical low prices, you need to re-own it for whatever reasons out here. We've always said that the American farmer always gets at least one opportunity to market his crops at profitable levels. We're there now on the corn, beans, and wheat. So they need to be doing something out here. And certainly, if you want to go ahead and pull the trigger, buy a call, stay in the game, because there could be some significant upside, particularly if it stays hot and dry in Argentina.
All right, so we've risen almost a quarter since January when we hit the lows on this contract. How much more steam do we have?
Maybe another 20 cents in the corn and the beans. You know, who knows? Maybe another 30, 40 cents, I think, fairly easily. The meal is not only taking out the October highs, we're on contract highs on the meal. We've just blown this thing wide open in here. The beans really haven't kept up with the meal and the crush part of the equation out here. So could the beans catch up to the meal? It's certainly possible. The funds are now long, so that takes a little bit of the oomph out of the market. But the fact of the matter is this market looks strong technically. Funds should be long. I don't see them giving it up. But again, one good rain over the weekend in Argentina is going to send this thing south again.
So you're talking beans, but the same is true in corn, yeah. But
Absolutely.
as we move into the bean contract more formally here, as we'll show you the chart, it is still, which one do you think is pulling more weight to pull this contract up? Dry South America or the meal on the complex?
Well, there's something going on in this market that I don't know what the situation is. The meal spreads in just the last week rallied about $10 from the March Dees contract. We've rallied that spread $10, which tells me somebody is heavily short and stuck. Is it the Chinese? Are they concerned now because of what's happening in Argentina that they're going to be caught short of supplies? Are the Argentinians concerned they're going to be caught short? So somebody's caught in this market. You don't see this kind of move on a nearby spread without somebody having a serious problem. So that's certainly part of it. Is that tied in hand to hand with the Argentinian weather? It may be, but somebody's caught the wrong way in this thing.
If it is China, they're closed for markets for the next 4 or 5 days because of the New Year celebration. Does that have any influence here, or is that a sign?
Well, we'll see where we can go with it. I don't believe that the Chinese New Year is going to have much to do with it. Maybe we'll see a little bit lack of demand over the next 4 days. No sales will probably be announced, that kind of thing. But the fact of the matter is, if it stays hot and dry in Argentina, beans and meal should certainly move higher.
And we would know over the weekend, markets are closed on Monday, so all of a sudden Tuesday, it's a long way to head into that weekend.
And my guess is we could be 10 or 15 higher or lower on Monday night, depending on what the weather does. Lord knows if they didn't get the rains and it's still hot down there, you know, we could see another jump in these markets and give guys another opportunity to sell something, buy some more calls. But we're getting that opportunity now. We don't want to look it in the face and say, oh, this thing's going to the moon. We still have a huge potential carryout coming, so you've got to manage this risk.
All right, what risk is left in the cotton market, Mark?
Well, we've broken at 7-8 cents here in the last 3-4 weeks. We had it up to 85, back down to 78. There's still a lot of risk in this cotton market. I think this break is going to cause some guys to second guess how much cotton they're going to plant this year. So that may be an issue. We'll see how that plays out.
So that story changes in just 5 weeks' time since
certainly.
the first of the year?
Absolutely.
Because you're at that key point time right now.
That's right. We guys are making their decisions. You've had this drop off in price. You know, there's still a long way down to 55-cent cotton, so there's still plenty of risk out here. But I still think where corn prices are, where cotton and beans are, that we'll see more acres in cotton. The acreage report, I think, is going to be a matter of what's the spring weather going to be. We know the corn-bean ratio is telling us plant more beans. But it's been my experience that if farmers get good weather in the spring, they're going to plant corn. So I'm not sure that it's an economic game as it is a habitual game, if you will.
All right, livestock-wise, we're dealing with a little bit of a weather issue more in the feeder market than the cattle market, but the cattle market moving higher this week. Is this the time to be, I mean, we've seen some cattle pulled ahead. Is that what's moving this market higher?
Well, we had some fairly good demand. The stock market's come back, so that's helped rally this cattle market. It looks like the cash trades on Friday went out about 130 to 131, up $4 or $5 for the week. We still believe that in the next 6 weeks, we're going to see a lot of cattle coming to market and above and beyond what we can handle effectively, which tells me that guys are going to back these bids off in a big way. We're almost at the contract highs within a couple of bucks on the cattle. Certainly a good opportunity to lay some hedges in, protect this downside. Hope that the stock market continues, the economy goes, and that we have that demand. But we are constantly facing more cattle, more weight, more product coming into the market. And until we really get into the grilling season, I think there's some significant risk out here.
You said but it sounds like it's a big but coming. Yeah, all right.
Yeah.
We could discuss that a whole nother way. In the feeders, we've seen the southern plains, that drought. What has it done to the market? Is that in fact impacting the market more, what's going on in the southern part of the U.S.?
Well, I think that's partially part of the equation. Certainly the weather we had in the north with some of the snowstorms that we had affected it. The feeder cattle really haven't kept up with the fat cattle rally as much. We're still a ways away from contract highs in there. I would be very hesitant to be thinking that this market's going to push a whole lot higher, either fats or feeders. You've got the funds heavily long in the cattle now, near contract highs. Maybe we take it out. Maybe 134 would be a pretty darn good target to hit. And I would certainly want to be looking to sell some cattle at those levels, put in some hedges, buy some puts, do something to lock in those kind of gains.
Because you're probably not going to see that price for the while, is what you're saying. All right, on the hog-wise, is that a similar scenario? I mean, I saw this week there was a story about even domestically here in the United States, we're going to try, the pork industry is going to try to convince the consumer they need to buy more pork. Is that what needs to happen to help that market? Can we eat that much?
Well, you know, they're doing what they've always done, trying to get us to eat more pork. And I think they've done a pretty good job of that over the years. Fact of the matter is we had summer hogs up to 85 cents. Historically, when you get to 85 to 90 in this hog market, it's been a heck of a sale. And we backed off about $5 off of those $85 highs. Can we run it back up maybe in the summer? It's certainly possible out here. We certainly had recommended to clients at 85, buy some 82 puts for $3 and protect the downside and let this thing go where it's going to go. But the fact of the matter is, on a $5 break, I still think there's an awful lot of risk in this hogs. The nearby hogs are $7 to $10 under where we are in the back months. And I think that's indicative of maybe building in too much of a premium for the summer market. We'll see how it can work out, but anytime you get these hogs into the 80s, you've got to be thinking hedging. One time we took it out, and that was during the PED scam when we went to, I think, 120. I don't see that on the horizon. But again, I don't know.
Well,
but that's why I'll have a put on. If we do get something crazy that pushes us over 90, fantastic. But this historically has been a great area to get some hedges on. I hope guys did it when they had the opportunity.
The dollar back below 90 Does it have legs to go low? Do the legs get cut out, or does it go up higher?
No, I think the dollar's got some serious issues in here. And I'm guessing, if I had to take a wild guess at where we're going, I think we can see 83 or 84 cents on the dollar.
Oh, wow.
I mean, I think we've got some risk there.
I think we'll cover that a little more in Market Plus. Thank you so
Great.
much, Mark
Thank you.
Gold. Appreciate that. And before we go, as many of you know, Mike Pearson resigned from Market to Market back in December. This week, the search for his replacement came to a close. To date, there has only been 3 hosts in the more than 40-year history of the program, and tonight we introduce you to our 4th. John Torpy has the details.
There was plenty of action in the grain markets as the trade piled on to an
Delaney Howell may be new to the market-to-market desk, but her passion for agribusiness reporting was set when she was a little girl growing up on a cattle farm in southeast Iowa.
I grew up watching Market to Market. My dad would turn it on every Friday night. That was like church. You didn't miss it. And if you wanted to watch, you could watch. Otherwise, leave the room or be quiet.
Howell's desire to become a farm broadcaster was sealed when she witnessed firsthand how news was reported by Market-to-Market's second host, Mark Pearson.
Rising gasoline prices drove U.S. consumer costs sharply.
I got to hear him on multiple platforms. I watched Market to Market. I listened to The Big Show. So he was my first real taste at farm broadcasting. And I used to just remember, that's so cool. Like, I would love to do that for a job, be on the radio or be on TV and just talk about agriculture. And now I get to do it.
In 2015, Howell became an intern for Market to Market while attending Northwest Missouri State University to study agricultural sciences and broadcasting.
one company has helped ensure that
The stories Howell produced for the program took her across the country, covering everything from catfish farming to forestry.
Agriculture is where I feel at home, and that's my people. So that's the stories I keep wanting to tell is agriculture's. People sit down to watch this show every Friday night or whatever night it's on for them because your livelihood depends on it.
As she returned to college for her final year, Howell continued to report for Market to Market, examining agribusiness startups in northern Missouri. Since graduation, her farm broadcasting resume has expanded from television to include radio, print, and various online platforms. She is also tackling a master's degree in agricultural communications at Texas Tech.
The Weekly Journal of Rural America.
Hello, I'm Delaney Howell.
As the first woman to host Market to Market, Howell looks forward to fulfilling the dream she set for herself as a young girl.
I think we can do a lot of things now that set us up for the next 40 years.
For Market to Market, I'm John Torpy.
Delaney Howell, welcome to your domain. This is your place now.
It is. I'm excited.
So this is an area that, as we talked about in the piece, you've watched this show for a long time. What's it going to mean to you to take over in this turbulent times of agriculture?
It's really exciting. I'm very honored that I was selected to take over as the show. And as I mentioned in the piece there, I've watched it since I was little. That is church for a lot of people. You don't miss church and you don't miss Market to Market. So I'm very excited to ask the right questions when we get to the table with analysts and hopefully help people improve their livelihoods. And I mean, a lot of people base their marketing decisions off of what they hear here at Market to Market.
So if you had to pick 2 or 3 things that are really going to be important for us to be watching here coming up, what do you think those will be?
Market-wise?
Yeah.
I think a big one right now is exports. Soybean exports, that's a big thing. We're behind pace right now for USDA projection. Also just the fact that we're in a global grain glut. And I have to watch the cattle markets because, as you saw there, we have cattle at home. So
also in that piece that didn't make the cut, that will be on our Facebook page, is the reaction your grandmother had when you got it. So that'll be fun to see for everybody. We'll have that in a little bit. Facebook, Twitter, Snapchat, Instagram, whatever. After you were named here, it was official this morning. I had you only down for 150 new followers on your Twitter account. What's that reaction been like to see as people are saying congratulations to you?
I knew going into it, it was going to be a big reaction, and I kind of had to mentally prepare myself, especially because I mean, people are going to recognize me, and that's just something I'm not used to yet, but I'm ready to take it on. And as you mentioned, yeah, my Twitter following has already skyrocketed through the roof. I think I'm up to like 750 followers at this point in time. So
I
I'm
had
excited.
718, so yeah, I
Yeah.
haven't looked. It's been a while.
I'm
since I
excited to
looked.
communicate. I think that's a way that people are able to directly communicate with market analysts, with people in the ag industry, and ag Twitter especially is very popular.
All right, at Delaney Howell 07.
That's right.
Is that right? All right, Delaney Howell. One last Friday night off, and then it starts for real next
That's
week.
right.
All right. Thank you. Congratulations
Thank you.
as well. All right. And that wraps up the broadcast portion of this edition of Market to Market. And you can catch more market discussion and Market Plus available in podcast and video form on our website. And while you're there, check out the M2M podcast, a peek behind the scenes of this program. We talked about pecans this week. Next week, we, on Tuesday, will cover how we arrived at selecting Delaney as our new host. So until then, thanks for watching. I'm Paul Yeager. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.